Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. The infrequency with which many bonds trade can mean some investment strategies don't get off the starting blocks, with traders pushing back on their portfolio managers. To find out how an investment manager can manage this information disparity and deliver returns over the long and short term, we're speaking with Sean George, Chief Investment Officer at hedge fund Structurinvest Fondkommision. Sean, welcome back to Trader TV.
Thank you for having me again. I'm happy to be here.
Tell me, how do information gaps in the market affect your ability to actually trade either long or short-term positions at the moment?
Our job is to make decisions with imperfect amounts of information. So what we do is we try and analyze it quantitatively and top down, bottom up, and try and gather as much information around whatever security or market that we're analyzing. We maintain our core portfolio, the things that we have on for longer periods of time, but we increase the velocity or the amount of short-term, we call them singles, short-term trades that we're trying to just make, 5-10 basis points on. It's a switch. Where we bought CDS on Generali and sold CDS on Aegon. So in essence, we went short an Italian asset and long Dutch asset, and or really it's a U.S. asset if you break it down. But and why would we do that? Well, we think the spread at 12 basis points between the two is too tight, and the headlines out of Italy and the European elections coming up, that we can get some volatility surrounding Italy, but it's not a market directional trade, and it's more of a nip and blip, as we would call it. Yep. So we have a large, or we have a lot of those kind of trades in our portfolio that we'll put on and we'll take off. When
you're taking both those shorter term opportunistic positions and the longer term positions, does that place any strain on the sort of data sources that you're using?
So any trade that we put on, we put it into our model portfolio, or what it is our actual portfolio, with the addition or subtraction of the risks that we're trying to augment the portfolio with. And then we take that data backward looking and try and feel the volatility, look at the metrics that the portfolio comes out with. We monitor stuff with the volatility of our portfolio, and obviously the data that's going in is very, very important. And I'm not paid to say this, but City Velocity does have a great source where we can get very good data. But then we also have to go through and check the data. Yes. So being a market participant for 23 years. You go through and, okay, this looks right. But then even though you get data that is good, you're going to still see some spikes, and then you gotta take that into consideration when you're making the evaluation for the trade.
And how do you manage the time it takes to actually run that process?
We do it fast. We do it fast. I mean, longer term core trades are generally like deep credit or documentation trades. Yeah. So we don't necessarily. Like if I'm going to put on RBS 6425s, which is our first position we put on, I'm going to put that, I might have that on for 2 years, just because I think the asymmetrical payout for holding that bond is so high. Yeah. So I'm not in as much of a, I got to have this on now, because we spent a lot of time on, in this case, documentation, or if it's Altice, which was our best high yield long this year, we spent a lot of time on the credit side of things. Obviously, we're going to model the volatility, but like the Generali Aegon trade, that I want to put on right now, because the levels the relative levels have gotten to an area where it makes a lot of sense. I'm paying basically 12 basis points to be short Italy, and Italy is wobbling, and we have some macros going on throughout Europe. So then I'm in a hurry, and poor Jesper has to do that within, I need an answer now. So it's really, he has about 15 minutes to get that back. But once again, that's not something that the size of that trade is smaller than a proper core that sits in the book for up to to when it's played out.
And so that has less market impact.
Yeah, exactly.
Okay. So what are the risks that an asset manager faces when trying to manage those opportunistic and the longer term trades together?
Time. You want to make sure that you are indeed thematically positioned correctly. And you're not too focused on the nip and blips. and I think I can make 5-10 basis points on this. That's great. But if you miss the macro theme or a sector theme or a geographic theme, well then you've missed the trade, the big trade. So the short-term opportunities are there to enhance your thematic trade. And ETFs are selling too much into the market and not realizing that, okay, you've knocked it down 3 points, stop selling the same bond. Well, that's when it comes up on our quantitative scan that, hey, this bond has dropped too much versus the sector, and then we jump in and go, wow, that bond's dropped 3 points, the rest of the sector's flat. What's going on? You pick up the phone. Hey, it looks like there's some structural selling of that bond. Okay, this seems to be a short-term situation. Jesper, model it. Look at what it does to the vol. Okay, we're okay with the credit. This is just a short-term blip. We step in.
It sounds like that would be something that would be very difficult for a larger asset manager to do if you're segregating trading and investment, perhaps.
Well, I'm not a believer of segregating trading and portfolio management. You miss so many opportunities, and also you miss the things that are probably the most dangerous. And then when you go on comp, 32 dealers in comp, well, 32 dealers don't have an axe in that bond.
Yes.
But some of them are going to try and get that axe, and they're going to change the price before the transactions happened. And you don't have that problem when we've decided to go into something, because I can see the 2 or 3 guys or girls that are axed in that bond or that CDS. And I go to them. And then I've still got my best execution. I'm still MiFID compliant.
Yeah.
Because I can see the screens. I've asked more than one person, and everybody wins.
Sean, that's been great. Thank you very much.
Thank you very much for having me again.
I'd like to thank Sean George of Structurinvest Fondkommision, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.